Hello and welcome to Hardman Talks. I'm Larissa Adams and I'm here with Hardman & Co.'s property analyst, Mike Foster. Mike, it's great to have you here. How are you doing today?
Hi, thanks. Very well.
Great. Okay, so Mike, you've had over 30 years experience covering a wide range of corporates in the property sector, with time on both the buy side as a fund manager and as a sell side analyst too. So in this episode, we're going to be doing part 2 of where we'll be looking at REIT prices versus NAVs. We'll also be looking at how NAVs have behaved over the last year and what some of the underlying drivers may be. And that includes the effect that rent prices are having. So let's get into it. Mike, in 2023, REITs closed out at a 7% discount to NAVs, which is almost exactly the average over the past 30 years. So are REITs expensive or are they cheap right now?
Yeah, REIT prices at the end of 23 were pretty much priced in line with the historic averages, as you say. Last month, we looked at the story of the global REIT prices versus NAVs. So they did end on that 7% discount. That's now widened at the end of January, start of February, to a 10% discount. So that's one building block to taking an investment view. They're slightly cheap versus the long-term trend, but we must look at the assets.
Yeah, and what have we seen from NAVs over this period?
So NAVs did see a dramatic fall in 2022, but they're now much steadier, albeit still falling a bit. This month's Hardman analysis is about NAVs, how they've been moving, particularly in 2022 and 2023, but also over the past 7 years, and how we believe that all the sound and fury actually died down in 2023. It might not have seemed like it, but a real stability of sorts was achieved. Living in it made it seem like a roller coaster again. But we'd like to show the story standing back a little from the canvas, and it is building a firmer base. Yet we're not seeing investor volumes rise, nor are we seeing capital values rise. The CBRE data, which we quote in this document, saw UK total commercial property asset values fall 3.9% last year, 2023, 1% of which was in December alone. And the negative trends are driven by that disappointment in the investor transaction values, which were very low.
Yeah, and how have rent prices been factored into this? And are any of the movements significant enough to impact the sector?
Yeah, rents are rising, not much, but in addition, they seem to have bottomed out in retail, which is very interesting. So that wasn't bad, with a 3.6% 2023 rent rise in total commercial property. But retail rents at long last are bottoming out. Though those in offices, while statistics say they're rising, do seem to us to be a bit at risk, and voids are probably the risk there. Even there's well-founded hope of quietening trends, and we'll explore that next month. Overall, commercial properties are yielding 5.6%. So though capital values fell by 3.9%, there was a positive total return. It wasn't big, but it was a first step. CBRE and many other agents quote prime property when announcing market rent rises. So we do wonder if this does distort to flatter. The 7% rent rises for 2022 in this table here may well be above what the total market really saw. While 2022 was tough in geopolitics and stock markets, the rent rises reflected the bounce from COVID. So all eyes then were on 2023 as to whether rents would fall. They rose. Data above indicates by 3.6%. Within that, office rents rose 2% and retail rents growth was de minimis, but at least falls seem ended, with the caveat this is for higher quality assets. So all we would say is that there was a modest rise for the commercial market overall, but that was all important. By the way, the investor appetite for alternatives to the stalwarts of office and retail assets is borne out by the rises in these so-called alternative areas, particularly but not only industrials, being much above the average. Then in the chart, we look at 2023 property yields. They rose a bit from 5.2 to 5.6% as prices drifted down and rents edged up. That reflected the small rise in gilt yields, again on the chart. So it does make sense. And it's a small figure, small change. This table also quantifies the pricing of REITs, and REITs, as we said earlier, ended 2023 priced almost bang on the 30-year average of 7.6% as calculated by the share price discount to NAV.
Okay, so is your message more that volatility is reduced rather than a pickup that's been seen?
Yeah, 2023 capital values fell and rents rose, but both numbers are modest and that volatility did reduce. Second half of 2022 saw UK total commercial capital values fall by 19%, CBRE data, after a rise in the first half. 2023 first half was down 1%, second half saw a 3% fall. That's the big picture. Let's look at how the detail builds up to the story. So if we look here at the UK property market and REITs and wonder how fragile that investment basis has become, it starts to look a bit more solid, driven by the rents going up and the REITs priced about right value to NAV. See our talk last month. Commercial properties covered by CBRE in their basket yield 5.6%, but at least that's up from the 5.2% a year before. That said, UK 10-year gilt yields actually rose further in 2023, ending at 3.7%. But again, in gilts, that was usefully below the 4.7% peak in a more roller coaster year for them. We look at rents and yields in a future talk. We also look at how big a whole property might have dug itself in a future talk. For now, our story is to quantify the recent 7-year history of total returns and changes in capital values and tie that in to the REIT share prices relative to NAV. So there are two elements when we try to reassure ourselves that we're not overpaying when buying the UK REIT market. One is the REIT price relative to NAV. Perhaps more important is the NAV itself. NAVs seem to us to have fully unwound the fears of 2020, the optimism of 2021 and the first half of 22, while the retail bricks and mortar story is an interesting sign that even bear stories can get played out.
Yeah, so where the average discount to NAV for REITs is now could be pointing to the fact that most of the sector risk and volatility it might be priced in. But how should investors look at total returns?
Yeah, so we conclude that while REITs don't offer a huge bargain, nor are they overpriced by historic standards, and that 2023 capital values and rents have been remarkably stable. That's how the big picture story goes. And we can look at how we come to that view. Let's look at UK commercial property total returns in the past 7 years. So in this chart, data which is from CBRE, covering a representative range of individual UK commercial properties, is annualized here, collected quarter by quarter. The year on the x-axis is by its first quarter, by the way. This chart is the total return for each quarter multiplied by 4 to annualize it. In 2020, total returns kicked off with 2 negative quarters, but the world soon turned positive and total returns in 2021 averaged 19%, rising as much as 30% annualized in the fourth quarter. Let's add each quarter's capital returns up to get a line chart. So post-pandemic optimism has unwound, and the trends here in the capital values only have broadly found stability in 2023. So this chart is how the returns totaled up, the capital returns only, and they're rebased to 100 at the end of 2016. The top line is actually capital plus income, and the lower line is that capital only line. So the top line is capital plus income reinvested, lower line is capital only. 2021 was a bumper year. The total return line began 2021 at 119 and ended at 142, which is 19% up. Even excluding rental returns, so that's the lower line, UK commercial property values rose 6% in the first half of 2022, or a 12% annualized capital return first half of 22. That optimism unwound in the third quarter of 2022. It all changed. And even though those falls are fresh in mind and they're big, it's worth reminding ourselves how sharp the falls were. Unlike the 2020 pandemic falls, which came after a year of minimal total returns, second half 2022 falls were reversing that strong 2021 and strong first half 2022 total returns. UK commercial properties covered by CBRE in their basket yield 5.6%, up from the 5.2% at the start of 23, through modest rises in rents and falls in capital values. This rise tracks small 2023 rises in gilt yields. So it all seemed both to make sense in that tracking and also, really importantly, be far less volatile than 2022, 2021, and 2020.
All right, thanks, Mike. I think, shall we end off by summing up your key takeaway messages from this?
Yeah, we'd conclude that we're balancing long-term capital value falls, the fact that the retail sector seems to have bottomed out, found a bottom, and also the low market transaction volumes. So rents continue to rise, and the current yield must be a great factor in reducing the valuation volatility. It's good support. Then we have the REITs themselves. In the second half of last year, 2023, the average global REIT share price averaged 12% below NAV, but there was a strong rally in the fourth quarter of last year. So 2023's year-end figure was a 7% discount in share price to NAV. The very recent drift at the start of 24 in some of the major share prices has taken that average REIT discount to around 10% now at the start of February 24. A 10% discount is a decent value compared to the last 30 years, as this chart that's going up shows. Through 2022, you can see how it all turned sour, and that was from quite a heady 2021. From 2014 to 2021, the discount bobbed in a narrow range of 6% discount to 1% discount. And as global inflation and short and long interest rates rose, so too did the discounts to NAV within the REITs. 2023 has been much more remarkably calmer, with both share price discounts and also the NAVs that we talked about earlier quietening down. Certainly asset values are still falling, but modestly so. Certainly share prices are volatile. 2023 saw share price lows a third below the year highs. So it was definitely another volatile year last year. But it ended with a strong rally. So for the year as a whole, 2023 share prices hardly changed. And that's kind of important to stand back and see that. So our message is that at a now 10% discount to NAV, the REITs trade about 3% below their 30-year long-term average, which is reassuring. UK asset values fell 4% market-wide last year, 2023, but very importantly, rents rose by the same amount, a bit more, which is reassuring. It's been a rough few years, but stand back, and we now seem in a decent, increasingly solid place.
Yeah, thank you so much for your time again, Mike. It's been extremely valuable for investors. And to our viewers, thank you again. Please don't forget to like this video and join in the conversation by commenting below. We appreciate your time, and we'll see you back here next time. Thanks.
Yeah.